when you buy an option for AMC or any other stock for that matter, well, when your option becomes in the money, it means you have two choices. You can either decide to exercise that option and then buying 100 shares of for your contract at the strike price, which is lower than the actual price where the stock is trading, which gives you money, makes you a little bit of gains. Or you can decide to not exercise that, and then you will lose your premium on the option. Now, in the case of most of the people will do is they will buy the actual underlying shares at the strike price. So the market maker who then sold you that option has now the obligation to buy the shares in the market. But sometimes those market makers will fail to deliver, meaning they will fail to buy those shares. And even though you can see shares on your account, those are phantom shares. They are not real shares. And they have T plus 35 as a time frame to actually buy the actual shares. And that's how failure to deliver means. But when you look at the whole volume on the failure to deliver for AMC since June, for example, it goes all the way back to May, but the volume is not that big starting June, because June is really the month where the share price really spiked up. And as a matter of fact, we have a ton of volume when it comes to this failure to deliver. Look, June 1st, we have about 1.8 million shares that needs to be bought. This is just the amount of shares, not even the notional, the dollar amount. This is just the amount of shares. Look, on June 2nd, we have another 1.25 million shares. And then June 3rd, you have about 5.4 million shares at the closing price of 62.55. Guys, this is like $340 million when it comes to the dollar amount. This is huge. And then it goes, June 4th, also 1.4 million. So if you just add up for these 4 days, man, we're talking about what? Maybe 8-9 million shares that will need to be bought at an average price between 26.52 and 62.55. This is an incredible amount. So maybe this is the reason why anytime the share price will try to hit $60, they will try really hard to push it down in order for the share price to be either, around the 58 to 55. But we've seen this in the recent weeks. Anytime we'll pass $60, hedges will try really hard to push it down to, below $60, because maybe they know that, once we reach $60, because they know that they have to buy this incredible amount of shares as a result of the failure to deliver, because they just handed phantom shares to people who actually had those options in the money. Well, the T plus 35 is kind of closing up on them. And because they know they have this huge amount of shares that they need to buy, well, they're trying to buy this as low as possible. Because guys, if they have to buy huge amount, talking about 500 million possible, in dollar amount, well guys, this might spike this thing to what? Maybe $100, maybe 125, not even counting FOMO, not even counting technical breakouts, not even counting all the other mutual funds that are in here to add the position, especially with Adam Aaron coming here today and saying there is no more, 25 million share issuance till the end of 2021. So that might also bring us to maybe 155. I don't know. I'm just speculating, but it's definitely clear that with such a huge buying pressure coming from, those market makers, possibly we can see a short squeeze from on the hedge side. It doesn't necessarily mean that any guarantee is going to happen, the way this data is suggesting, because hey, multiple times we've seen this in the past. You make your due diligence, some things might look, hopeful, but it ends up not happening. But at least this is a plausible scenario. But again, guys, we have to expect for the best and prepare for the worst.